Hey, this is Blake Yarborough with Investor Lending. I'm going to tell you why I choose hard money loan by showing you a comparison of conventional loans. And you'll see how maximizing leverage really makes a difference. First of all, here's our assumptions. We have the after repaired value of $130,000. After we buy this house for $80,000, we put $15,000 in repairs in. The appraiser will say, give us the after repaired value of roughly $130,000 in this estimate. On that same house, when we get it rehabbed and rented, we'll rent it out for $1,350. We're going to assume $5,000 for each closing. Bigger loans would be more in closing cost. And then taxes or insurance are roughly $350 a month. So this is a typical deal where people come, put 20% down. So we'll break that down for you. So 16% is 20% of the 80. We've got our $5,000 in closing costs right here and our $15,000 in repairs. When you've done all that, you have roughly $36,000 out of pocket, or exactly $36,000 out of pocket. At that point, we have a $64,000 loan at 4.5% interest rate on a 30-year fixed, non-owner occupied, and its current market rates. That gives you a $324 payment plus $350 for taxes and insurance. Your total payment for principal, interest, taxes, and insurance is $674. At this point, we rent it out. We get our $1,350 from a rental amount, bring it down to here. $1,350, netting it out, we have $675 a month cash flow. It's pretty good. If we annualize that, that's $8,000 a year on that property, 8108. Now we take the $36,000 that we were out of pocket and we divide that by the 8108, we have a cash on cash return of 22%. So our results on our first deal is $66,000 equity, $8,100 in annual cash flow with a 22.5% return. That's a very solid deal that many people would be happy with. But more experienced investors like myself, we tend to do a hard money loan. And here's why. Well, first things first, it maximizes leverage. Let me show you how to estimate what your cash out of pocket is. I simply take a little T-chart, the amount needed, the $80,000 for the purchase price plus $15,000 repairs gives you $95,000. Well, your max loan is the $130,000, and typical hard money loans are at 70% of the after repair value, so that gives you a $91,000 max loan amount. So at this point, we need $95,000, we have $91,000, we have a $4,000 shortfall. We estimated $5,000 for closing costs. That means your estimated out of pocket in this scenario is $9,000. So once we rehabbed it and now we're ready to refi. We owe $91,000. We're estimating $5,000 in closing costs. We need $96,000. Well, 75% is the max loan on a refi. So 75% of the $130,000 is $97,500. Well, we only need to estimate $96,000. So that gives us roughly $1,500 that either we could take as cash back to borrower, or many people use that to set up their escrow account to have their taxes and insurance in the note. So now we are at a $97,500 loan at 4.5% interest rate. That gives you a payment of $494. Yes, that is higher than the $324. But let's go further. If you analyze that over 12 months, you have $5,928 of annualized cash flow. If you divide that $9,000 that we were out of pocket up here by that $5,928, that gives you a 65.9% cash on cash returns. A lot higher than the 22.5%. But see, the thing is, yes, your cash flow's here $5,900 and the cash flow here is $8,100, but the part we're leaving off, you can do 4 times 9 equals 36. So now, if we do it 4 times, we have $23,712 annualized cash flow using $36,000 out of pocket, the same number here. So let's look at our results on the hard money. We have $130,000 equity. Our annual cash flow is $23,712, and our return on that is 65.9%. Compared to the results on conventional, it's $66,000 equity, $8,100 annual cash flow, 22.5%. So now what I would like to just clarify things. With a hard money loan in this example, we were able to get 3 times the cash flow, 3 times the return percentage. Okay, we have 2 times the equity, we have 4 times of the appreciation, 4 times the depreciation, and more diversity. By that I mean, if you only have one property, you're either 100% rented or you're 100% vacant. When you have multiple properties, that mitigates the risk. So that's my quick lesson today on the comparison between conventional loan and hard money loan. I hope you find it educational. Thanks.